The parent company of the New York Stock Exchange just invested in a crypto exchange at a $25 billion valuation. Kroken became the first digital asset company to receive a Federal Reserve master account. Morgan Stanley applied for a crypto broker-dealer license, and 5 regional banks are building a shared tokenized deposit network. All of this happened in a single week. Let me walk you through it. Hey, this is Mark. Welcome to 51 Insights and welcome to our weekly Friday briefing. So let's get into it. ICE, Intercontinental Exchange, New York Stock Exchange's parent company, has taken a minority stake in OKX, valuing the crypto exchange at $25 billion. ICE invested roughly $200 million, secured a board seat, and licensed OKX spot crypto prices to launch US-regulated future contracts. In return, OKX 120 million users gain access to ICE's future markets and New York Stock Exchange tokenized equities, pending regulatory approval by the second half of 2026. OKB surged over 35% on the news. Now, here's why this matters. This is ICE's third major crypto infrastructure move in 4 months. It's buying infrastructure piece by piece. Polymarket gave it a data layer it can license into derivatives pricing. The BNY and Citi partnership locked in clearing and settlement. OKX adds distribution, 120 million crypto users who will get access to New York Stock Exchange tokenized equities. And the business model is actually quite straightforward, licensing OKX spot crypto prices to launch regulated US futures. The same data licensing playbook ICE has run for 20 years. It now controls the exchange, the clearinghouses, the data pipes, the prediction layer, and the crypto user base. We actually sat down with Michael Blaugrund, VP at ICE, to talk through exactly what this means. That interview is live, link is in the description. Next up, Kroken Financial, Kroken's Wyoming chartered bank, has become the first digital asset company in US history to receive a Federal Reserve master account. Granted by the Federal Reserve Bank of Kansas City on March 4th, after a 5.5-year regulatory process. The account is a limited purpose Tier 3 structure, so Kroken must hold 100% reserves, earns no interest on deposits, and has no access to the Fed's emergency lending window. But here's the key. With this approval, Kroken settles directly on the Fed balance sheets in real time. No intermediaries, no holds, full US government-backed finality. That closes the last major gap between crypto and traditional finance settlement. BNY Mellon and State Street institutional pitch was built on exclusive Fed rail access, and that exclusivity just ended. The timing matters too. This lands right before Kroken's IPO, and the Fed master account is one of the most powerful things you can put in your S1. If you want to understand what this means for the custodian pecking order and how it affects every allocator running an RFP right now, we break that down in this week's Pro Briefing. The CEO notes also cover what the ICE OKX deal signal about which public chain wins the tokenized equity race. If you're making infrastructure or allocation decision in the next 6 months, link to subscribe to Pro is in the description. All right, Morgan Stanley. They've applied for a crypto broker-dealer license with the SEC, moving to offer direct Bitcoin, ETH, and SOL trading to E-Trade users through Zero Hash as the backend settlement layer. This follows the bank's earlier OCC filing to create Morgan Stanley's Digital Trust, a federally chartered national trust bank focused on crypto custody. And when you zoom out over the past 6 months, the picture becomes really, really clear. Morgan Stanley has filed for Bitcoin and Solana ETFs, hired its first head of digital asset strategy, applied for a crypto trust charter through Morgan Stanley's Digital Trust for Custody, and updated its investment committee guidance to recommend 2 to 4% crypto allocations to its 16,000 financial advisors. The broker-dealer license connects it all. Custody via the trust charter, trading via E-Trade and Zero Hash, product access via the ETFs, and distribution through the advisory network. These 2 filings alone, a trust charter for custody and a broker-dealer license for spot trading, give Morgan Stanley the full client stack in crypto with E-Trade's retail base as the distribution engine. Now, this one flew a bit under the radar, but it's worth paying attention to. 5 US regional banks, Huntington Bank shares, First Horizon, M&T Bank, KeyCorp, and Old National Bancorp have formed a consortium to build Carry Network, a permissioned blockchain platform for tokenized deposits. It's led by Gene Ludwig, former US comptroller of the currency. They're targeting an MVP in March, a pilot in Q3, and full customer rollout by Q4 2026. And what's interesting here is the pattern. BlackRock, Morgan Stanley, and JP Morgan all ran private and permissioned blockchain experiments first, and then graduated to public chains like Ethereum and Solana for live products. BlackRock's Biddle Fund and Franklin Templeton's Benji are the clearest examples for that. The regional banks building Carry on a permission network today may well be the same trajectory. And with the Genius Act moving through Congress, the regulatory clarity that comes with it may exactly be what pushes regional banks to eventually move from permission networks to public blockchains. All right, 2 more stories before the newsflash. On March 2nd, Santander and MasterCard completed Europe's first live payment executed entirely by an AI agent inside a regulated bank. And the interesting thing is that this happened on real rails with real money. The AI agent acted within rules set in advance by the user, a spending limit, approved merchant types, and a time window, and completed the purchase without any human involvement at the checkout. DBS in Singapore and Commonwealth Bank of Australia have run similar pilots under both Visa and MasterCard. So what's happening here is that AI agents are becoming a new buyer class, and the 5 trillion checkout is being rebuilt around them. Card rails setting in 3 to 5 days can't support machine speed transactions, which makes stablecoins the natural settlement layer. MasterCard's already there, enabling stablecoin spending at 150 million plus merchant locations via Circle, MetaMask, and OKX. And here's where it gets interesting, because the real stakes sit in the standards battle. Stripe and OpenAI back one protocol, while Google, Visa, Shopify, and Walmart back a rival open protocol. Whoever wins controls how 3 to 5 trillion in annual agent-driven commerce gets routed, discovered, and settled. MasterCard also announced it's processing 160 billion transactions a year, and it's now letting AI agents spend that money for you. That's a big deal. Quick note on Stripe and PayPal. PayPal officially denied being in sales talks with Stripe, and its stock dropped after the denial, reversing the initial 7% pop. So that rumor is dead for now. All right, let's run through the news flash. BBVA joined a bank consortium to issue a European stablecoin. Another major bank stepping into issuance. Bitcoin ETFs saw inflows for the first time in a month. There are rumors a Hong Kong entity was behind the recent crypto dump, unconfirmed but worth watching. So Hong Kong is pushing forward while the mainland pulls back. That tension is going to be a story all year. Then UAE granted approval to launch the first dirham-backed stablecoin, DDSC. Then Chainlink will participate in the Bank of England's synchronization lab. When a central bank invites an Oracle network into its sandbox, pay attention. And BitHump has put South Korea regulators on alert. All of these stories and what they mean for your institution are covered in our Pro briefings. Pro subscribers get the CEO notes with alpha insights, positioning signals, and the analysis that goes deeper than what we can cover here in this video. Link to subscribe in the description. So that's a wrap for this week. If you're heading into a strategy meeting, 3 questions worth raising. Does your custodian evaluation account for Kroken now having a Fed master account? Is your team tracking what ICE is assembling because they're building the infrastructure stack that could define how tokenized equities trade by 2027? And does your institution have an AI agent commerce policy? Because MasterCard just showed us that's not a future problem, it's a now problem. That's it for this week. Thanks for tuning in and see you next week.